Here is a retirement scenario that plays out thousands of times every year and catches people completely off guard. Someone retires, their income drops significantly. They figure their Medicare costs will drop too. After all, Medicare is based on income, right? So lower income should mean lower Medicare premiums. And for most people, that logic is correct. But then they take a large withdrawal from their IRA, or they do a Roth conversion, or they sell a rental property, or they take a required minimum distribution that is larger than expected, and 2 years later, Medicare looks at that year's income, sees a number that is dramatically higher than their current retirement income, and adds an IRMAA surcharge to their Medicare premiums, hundreds of dollars extra every single month for an entire year, because of a financial decision they made 2 years ago that they assumed had nothing to do with Medicare. Today we are covering exactly how retirement account withdrawals interact with your Medicare premiums, the specific income thresholds that trigger surcharges, the retirement account strategies that minimize your Medicare exposure, and the one move that most retirees never consider that can keep thousands of dollars out of Medicare's reach every single year. Stay with us. Welcome back to Medicare Exposed. No commissions, no plans to sell, no agenda. Just the truth about Medicare, every single week. If you're new here, subscribe right now. Let's get into it. Let's start with the foundation. As we have covered multiple times on this channel, Medicare uses your modified adjusted gross income from 2 years prior to determine whether you pay standard premiums or IRMAA surcharges. In 2024, the standard Part B premium was $174.70 per month. The IRMAA surcharges kicked in at the following income levels. For individuals, $103,000 to $129,000, an extra $69.90 per month. £129,000 to $161,000, an extra $174.70 per month. £161,000 to $193,000, an extra $279.50 per month. $193,000 to $500,000, an extra $384.30 per month. Above $500,000, an extra $419.30 per month. For married couples filing jointly, these thresholds are roughly doubled. $206,000 to $258,000, an extra $69.90 per person per month, and so on up the scale. Now, these numbers may seem high, and for people with modest retirement incomes, they may not be a concern. But here is where retirement account withdrawals change the picture completely. The retirement account withdrawal trap. Traditional IRAs and 401ks are funded with pre-tax dollars. When you withdraw money from these accounts, the withdrawal is counted as ordinary income in the year it is taken, which means a large IRA withdrawal, a Roth conversion, or a required minimum distribution can dramatically spike your modified adjusted gross income in a single year. And that spike, 2 years later, shows up as an IRMAA surcharge on your Medicare bill. Let me give you a specific example. A couple retires. Their normal retirement income is $80,000 per year, well below the IRMAA threshold of $206,000. In their first year of retirement, they decide to do a large Roth conversion. They convert $150,000 from their traditional IRA to a Roth IRA. Their income for that year jumps to $230,000, which puts them in the second IRMAA bracket for a married couple. 2 years later, Medicare looks at that $230,000 and adds an IRMAA surcharge of $69.90 per person per month to both of their Medicare premiums. That is £139.80 extra per month, $1,677.60 extra per year for both of them combined, because of a Roth conversion they did 2 years ago. Now, the Roth conversion may still have been the right financial decision. Converting to Roth can be extremely valuable for long-term tax planning. But the IRMAA cost needs to be factored into that calculation, and most people never factor it in. Required minimum distributions, the unavoidable income spike. Starting at age 73, the IRS requires you to take minimum distributions from your traditional IRA and 401k accounts, whether you need the money or not. These required minimum distributions, also called RMDs, are calculated based on your account balance and your life expectancy factor from IRS tables. For people with large retirement account balances, RMDs can be substantial: $50,000 per year, $80,000 per year, $100,000 or more per year, and every dollar of that RMD is counted as ordinary income, which feeds directly into your MAGI, which determines your IRMAA bracket 2 years later. This is a problem that compounds over time. As your RMDs grow with your account balance, your IRMAA exposure can grow right alongside them. And unlike a one-time Roth conversion, RMDs happen every year, whether you want them to or not, the strategy most retirees never consider. Here is where this video gets genuinely valuable, because while the problem is real, there are specific strategies that can significantly reduce your IRMAA exposure from retirement account withdrawals. Strategy 1. Roth conversions before Medicare. If you are retiring before 65, the years between retirement and Medicare enrollment are a golden window for Roth conversions. Your income is likely lower because you are no longer working. Your Medicare IRMAA hasn't started yet because you are not yet on Medicare. And every dollar you convert from traditional to Roth reduces your future RMDs because Roth IRAs are not subject to required minimum distributions. Converting strategically during this window can dramatically reduce your future RMD income and therefore your future IRMAA exposure when Medicare does begin. Strategy 2. Qualified charitable distributions. If you are 70 and a half or older and you make charitable donations, there is a strategy called a Qualified Charitable Distribution, or QCD, that allows you to donate directly from your IRA to a qualified charity, up to $105,000 per year in 2024. The key benefit is that a QCD satisfies your RMD requirement, but does not count as taxable income, which means it does not count toward your MAGI and therefore does not affect your IRMAA calculation. For charitably inclined retirees with large IRAs and significant RMDs, the QCD strategy can save thousands of dollars in Medicare premiums every single year. Strategy 3. IRMAA bracket management. This is the strategy of being deliberate about which years you take large withdrawals and which years you keep your income lower. If you know you are going to need a large IRA withdrawal, consider spreading it across multiple years rather than taking it all at once to avoid crossing into a higher IRMAA bracket. For example, instead of withdrawing $100,000 in a single year, take $50,000 this year and $50,000 next year. If $50,000 keeps you below the IRMAA threshold, but $100,000 pushes you into a surcharge bracket, spreading the withdrawal saves you the surcharge in the year following each withdrawal. This requires coordination between your withdrawal timing and your IRMAA bracket thresholds, but the savings can be substantial. Strategy 4. Appeal IRMAA when income drops. As we covered in video 14, if your income drops significantly due to retirement or another qualifying life event, you can appeal your IRMAA surcharge using Form SSA 44. The same principle applies here. If you took a large withdrawal in a prior year, but your income has since returned to normal, and the withdrawal was a one-time event, you may be able to appeal the resulting IRMAA surcharge and have it removed. Work with a tax professional or financial planner to determine whether an appeal makes sense in your specific situation. The coordination conversation you need to have. Here is the bottom line. Medicare premium planning and retirement account withdrawal planning are not two separate conversations. They are one conversation. Every time you consider a large IRA withdrawal, a Roth conversion, or a significant financial transaction, the IRMAA implications 2 years later need to be part of that analysis. This is not complicated, but it requires awareness and a financial planner who understands both sides of the equation. A fee-only financial planner who specializes in retirement income planning can model the IRMAA implications of different withdrawal strategies and help you find the approach that minimizes your total tax and Medicare cost over the course of your retirement. The savings from this kind of coordinated planning can easily exceed the cost of professional advice many times over. Retirement account withdrawals and Medicare premiums are connected in ways most people never anticipate. But now you understand the connection, you know the thresholds, you know the strategies, and you know the conversation to have with your financial planner before you take your next large withdrawal. That knowledge, applied correctly, is worth real money every single year. Hit subscribe and turn on notifications, because next week we are covering the best states to retire in for Medicare coverage and costs, and the states where Medicare decisions are significantly more complicated than in others. We'll see you there.